Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. And straight ahead on the program, we look ahead to some key inflation and retail sales data here in the U.S. I'm Tom Busby in New York.
I'm Stephen Carroll in London, where we're digging into the challenges facing commercial and residential real estate ahead of a major conference in the French Riviera.
And I'm Brian Curtis in Hong Kong. We look ahead to earnings from China's contemporary Amperex technology. Number one in its industry, how is it doing in navigating China?
That's all straight ahead on Bloomberg Daybreak Weekend on Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 106.1 Boston, Bloomberg 960 San Francisco, DAB Digital Radio London, Sirius XM 119, and around the world on BloombergRadio.com and via the Bloomberg Business app.
Good day to you. I'm Tom Busby, and we begin today's program with inflation. We get key CPI data for the month of February this coming week, which could potentially influence what the Fed does at its March meeting. Joining us now is Stuart Paul, U.S. economist with Bloomberg Economics. Thank you for joining us.
Thank you for having me, Tom. Yes, we are looking forward to getting our February CPI data, and we are also going to end up getting retail sales data for the month of February in this coming week. And our basic view is that a bit of a resurgence in spending helped to create a bit of an inflationary impulse. We are expecting to see the headline CPI index increase 0.4% month on month for the month of February. That's the same as what we saw in January. And that is a very hot print and definitely inconsistent with the Fed's 2% target. That's going to hold annual inflation at 3.1%. That's year over year. Core inflation, we're expecting to register 0.3% month on month, allowing headline inflation to fall to 3.7% year over year. We are expecting to see some disinflation in core goods, with used auto prices declining about 2% during the month. But consumers are still spending, and that will support nominal retail sales growth during the month.
All right, so one bright spot you mentioned was used cars, a little lower. However, housing, gasoline and food, I know they fluctuate, but they have been a little higher than usual. Is that kind of driving a lot of that inflationary pressure?
That's right. So driving the headline really is gasoline prices. On a seasonally adjusted basis, we have gasoline prices rising about 4% during the month. So that's after accounting for the seasonal adjustment factors that typically would account for the increase in gasoline prices in February as people start driving once again, as they clear snow off the streets, for example. So
in some places.
So not only is gasoline driving headline inflation, it's also driving nominal retail sales. We are expecting to see retail sales growth of about 0.8% month on month. A big part of that is gasoline, and we need to account for that. If we look at a narrower control group, however, which strips out autos, strips out gasoline, strips out building materials, and food services, which is very heavily influenced by foot traffic, which can be affected by weather, for example, as we saw in January, very affected by weather. If we focus on that control group, we have a much more modest growth of 0.2% month on month in February.
Well, are some of the retailers doing better than now? January, we know that was a very rough month for retail sales. Could have been a hangover from the holiday season, but February, you're expecting a little bump ahead, a little bump up, not a decline like we saw in January. Who are the winners in that besides gas stations?
So if we look at credit card transaction data, and we look at debit card transactions, and just strictly count the number of swipes at credit card processing terminals at the point of sale, we do see big box retailers. We do see some just general merchandisers showing some of the most impressive growth month over month. But we need to be a bit cautious in how we read through from that 1 month of improved credit card transactions data and what that means for the broader economy. We are seeing some headcount reductions at retailers. That typically was something that was concentrated just in more high-skilled services. But if it's making its way to retailers, that could be a signal of retailers feeling a little bit of the pain or anticipating a slowdown in spending, which is actually what we expect throughout 2024.
Well, let's go back to inflation. Just not even 2 years ago, the inflation rate was 9.1%. Right now, we're expecting a year-over-year rate of about 3.1% or 3.7?
That's right.
Yeah, 3.1.
3.1% for the headline, 3.7 for core.
So we're moving in the right direction. Last week, Fed Chair Jerome Powell, in his semi-annual testimony to Congress, he said that central bank no rush to start lowering rates, but he hinted that when policymakers feel inflation is under control, could happen later this year, no firm timetable. Is he being optimistic? Is he looking at the data? It's all data-driven, according to the Fed. Are we heading toward that now?
I think we are. We're anticipating seeing headline inflation reaching about 2.5% year over year at the end of 2024. As headline inflation comes down, the balance of risks that the Fed has to weigh between achieving its maximum employment mandate and its price stability mandate come into better alignment. And so as we see the pace of hiring cooling, as we see the pace of inflation cooling, the Fed has to take its employment mandate a bit more seriously, has to put a bit more weight on it. And so we do expect the Fed to begin cutting rates this summer. Again, economic activity cooling, inflation cooling, and the labor market cooling would allow for that pivot in policy.
And the next Fed meeting, the 19th and 20th of this month, so we should not expect any rate cut, but you think we'll get a little more clarity from the Fed about what they're thinking?
I think that we'll get a little bit more clarity on the pace of quantitative tightening, for example, but I expect the Fed to actually maintain a bit of a hawkish tone in its policy statement. It did remove its quote-unquote hawkish bias in its January policy statement, but I expect the Fed to use language that would prevent people from reading too deeply into the idea that rate cuts are imminent or from expecting rate cuts to be imminent, lest financial market conditions start easing too swiftly, and the Fed would have to then treat loosening financial conditions perhaps with more restrictive policy or a higher for longer policy.
Oh, boy. Well, we'll get ready for that. Well, our thanks to Stuart Paul, U.S. economist with Bloomberg Economics. Turning now to two closely watched earnings reports that are out this week, which will offer investors a glimpse into the mania surrounding artificial intelligence technology. And for more on what to expect from Oracle and Adobe, we welcome Bloomberg Intelligence Technology Analyst Anurag Rana. Thank you for being here, Anurag.
Oh, I'm happy to be here.
Oh, good. Well, let's start with Adobe, which may be best known for its Photoshop editing software, Acrobat Reader, and its PDF, but boy, has it transformed itself into a cloud computing giant with its generative AI product, Firefly. So what are you expecting to see in the first quarter earnings out on Wednesday, and why?
Yeah, so, when you look at somebody like Adobe that dominate the creative space with the Photoshop and other products that go into it, they also dominate the document cloud business or digital documents with PDF. So those are the two areas where we see strength going into the quarter. So document cloud, I think that's done very well. We continue to expect strong results on that segment. The big discussion is going to be on the creative part of it, because there is a lot of chatter around what's going to happen to companies like Adobe when you have products that are, launched by companies like OpenAI. So I would recommend, if anybody hasn't seen the OpenAI's latest demo of their product called Sora, I would recommend go to YouTube and check that out. It's a phenomenal product where you just write down the text of, let's say, two armies fighting in a battlefield. It'll create a video for you, and that's done. I mean, you can use that. Now, there are a lot of concerns about privacy and copyright and other things, but we can, that could be settled later. But since that video was released, Adobe has been a lot under pressure. So I think on the conference call, we do expect management to talk a lot about what they're doing with their AI capabilities, et cetera. You mentioned Firefly. Firefly is an interesting product, but it's mostly text to pictures, which is text to, you can write down a text to say, create a picture of a dog playing piano in a forest, and it'll create that for you. They have done a good job of, ring fencing that issue by launching their own product, Firefly. And on top of that, they actually have agreements with the creative professionals who own a lot of those underlying pictures on which these models are trained. So they're basically telling companies, you can use the pictures generated from our system, and nobody's going to sue you for it because we have ring-fenced it with copyright issues. So I think there's going to be a lot of discussion on that topic, but Adobe, in our view, is on the right path of Gen AI, and over the next few years, we should see significant improvement in their products.
And over those next few years, is their main competition going to be the OpenAIs and other AI startups of the world?
It is a mix of OpenAI and other startups of the world. There is another startup in Australia that has been behind them called Canva. We just had their co-founder on our podcast. That's a good product, and also it's a slightly cheaper product. So it's going to be hard for Adobe over the next few years to put in new price increases through their ecosystem. They have been growing well with price increases over the last, I would say, couple of years, but I think it's going to be challenging going forward.
Wow. Okay. Well, on Thursday, we hear from the enterprise software giant Oracle. What are you looking for in its Q3 report?
Yeah, Oracle's actually a very interesting story because it has two big businesses. One is the application portfolio of software company or software products such as HR software or customer relationship software or finance software. And the other part is the infrastructure business, which is their database business, as well as they also do a bit of cloud computing. I think given such strong demand for a cloud infrastructure to run these large language models, the biggest focus for everybody is going to be what happens in their Oracle Cloud infrastructure numbers. I think last quarter, investors were a little disappointed by the growth rate of that. And the company came out and said that, listen, we don't have a problem with demand. The issue we are having is we don't have that much capacity to run that demand. Whether it's in the reason could be the data center expansion is a bit slow, or they don't have enough chips from NVIDIA to run those workloads. So I think then everything is going to rotate around what's the capacity right now for them to run that work. But other than that, I think it should be a normal quarter for them. I'm not expecting any major surprises other than the topic we discussed.
Well, you said that supply, not demand, may be an issue. Does that mean also businesses are still spending, still growing?
Yeah, this is a very good question. I think by and large, businesses are stabilized in the downdraft of IT spending that has been going on for 2 years, which means it's not getting worse, but it's also not getting faster at a quicker rate. The one area that's not, in that bucket is anything that's spent on AI. So they are spending a lot on AI, but they may not be spending on other areas such as, sales automation or marketing, advertising, etc. Those software products. But as far as AI products are concerned, there is a pickup in spending.
Well, a lot to look forward to, and our thanks to Bloomberg Intelligence technology analyst Anurag Rana. And coming up on Bloomberg Daybreak Weekend, we'll dig into the challenges facing commercial and residential real estate ahead of a major conference on the French Riviera. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in the program, a look ahead to earnings from a couple of key tech manufacturers in Asia. But first, the real estate world, both commercial and residential, has been struggling under the weight of high interest rates. And the cracks are seeping into the financial world as well. Flexible working has changed demand for offices, while many European countries are struggling with a shortage of housing. All these issues and more will be in focus at a major real estate conference on the French Riviera in the coming days. For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Stephen Carroll.
Tom, it's a subject that has huge political and economic importance. Real estate. High interest rates have created cracks in the commercial property market that are now rippling into the financial world. Home buyers are also dealing with higher borrowing costs, while at the same time facing a shortage of housing in many major cities. In the UK, the latest data from mortgage lender Halifax shows a continuing small rebound in house prices despite higher rates. We spoke to Kim Kinneard from Halifax about the risks that she sees in the market this year.
I think mortgage rates clearly are focusing everybody's minds. We've seen real volatility in them, and we saw significant rate increases over the course of last year. We're starting to see that ease now, and as we said, there's buyer confidence beginning to return. I think I would say, more broadly, it's just we still remain in a fairly uncertain economic climate. So I think there are lots of things that we need to be thoughtful about. At the moment, we're seeing really good wage inflation. We're seeing low unemployment rates, and those are good indicators for us in terms of the long-term performance of the market. But I think we've learned over the last 18 months or so that there is still uncertainty in the marketplace.
So do you see then stability for the housing market in the next few months? Is that the prediction to the end of the year?
As we're kind of facing into this year, I think, as we said, we think that house prices could drop by up to 2%. But clearly what we have seen in the last 5 months is consecutive growth. So that should be seen as a real positive. And we hope that that continues to grow and also that we continue to see stability.
So that's Kim Kinneard from Halifax on the situation in the UK for home buyers. From an investor's point of view, we've also been speaking to Michelle Scrimgeour, who is CEO of Legal and General Investment Management. She's been talking to us about the opportunities in the drive to build more homes in the UK, particularly affordable homes.
We operate in different sectors of the market. So we are a house builder. We operate in the build to rent sector. We operate in the affordable homes sector. We also invest into commercial real estate on behalf of multiple investors. We also lend as part of what we do here in the UK. We're not just doing it in the UK. But I think what we definitely see is continuing to see opportunity. And that for us is super important. And as the regulations are changing, so Solvency II is a very big thing for Legal and General, and the ability for us to be able to deploy more capital. We want to unlock the capital to invest. It means that we're going to be continuing to do that around the UK. So we think there is opportunity. Of course, the rates environment is a part of that. So, as rates become more stable, then I think that does start to make people more confident. And I'd say let's point to that as a point of resilience here for the UK, on which we can leverage. But individuals are still being impacted by those high rates in terms of mortgages, and fixed rate mortgages are a challenge. So there is a balance. But longer term, we do see a lot of potential here.
That was Michelle Scrimgeour, CEO of Legal and General Investment Management, speaking to Bloomberg's Caroline Hepker. Now, all of these issues are in focus at the MIPIM Real Estate Conference that's happening in Cannes on the French Riviera in the coming days. Our real estate reporter Jack Sidders will be there, and he's been telling us about the big subjects up for discussion.
I'm fascinated to get out there because I guess if we wind back 12 months, I was there in Cannes. And at the start of the week, Silicon Valley Bank had just gone, and I was anticipating, talking to investors about that all week. And by the end of the week, Credit Suisse was gone as well. And so it was incredibly chaotic, but also incredibly interesting and revealing to be there with all those investors and get to see the whites of people's eyes and sit down with them as this madness was unfolding. Here we are 12 months later, and although that US regional banking situation has maybe calmed down somewhat, albeit we'll see what happens with New York Community Bancorp, but the issues haven't gone away for real estate. And if anything, they've come to the fore more. It's such a slow-moving asset class. Prices take a long time to correct. That means issues with over-indebtedness take a long time to emerge, and then banks maybe take even longer to actually do something about it. What are the issues? Well, it's how much distress is really out there, how are lenders going to respond, how tough are they going to get with borrowers, what's that going to mean in terms of forced asset sales? Are we seeing funds that are under pressure with people trying to pull their money out? So I'm anticipating, the mood is likely to be as dour as real estate ever gets, because I've yet to meet anyone who works in property who isn't an eternal optimist. So I'm definitely sure every broker I meet will tell me that we're right around the corner for good times, and that the market's going to bounce back. And to be fair to them, there is a good argument that maybe people like me will be focusing on some of the more painful, distressed elements. There's definitely this sense that with interest rates having peaked and cuts on the way, that there could be quite a big bounce back. So for those with capital to deploy, they'll be out there looking to do deals. They'll be excited to start deploying that capital.
Because prices have come down. When you think about commercial real estate, prices have come down significantly. I mean, where are the bargains to be found for those that do have the money?
Yeah, absolutely. Well, I guess it's a global event, but I guess it's dominated by European investors. So if talking about Europe, the UK has probably corrected the most and the most quickly, which is what we normally see, and it's to do with sort of nuances around valuation approaches and whatnot. So, London, for example, prices have come down sharply, and the issue really is about availability. That bid-ask spread has narrowed. What often happens at the start of a correction is you just get this huge bid-ask spread as, nobody wants to sell at a discount. They've got their sort of backward-looking book valuations, but buyers want to pay a price that reflects where the risk-free rate is now. Anyway, that process has sort of been unfolding in the UK for the last, almost 2 years now. So the conditions are there potentially for a bit of a bounce back in terms of activity. Debt's maybe a little bit more available than it was. It's a little bit less costly than it was, so it can be accretive for some buyers, and that's so important in real estate. If we look across other markets, I'd say Germany is probably the other end, and that's the other really big market in Europe. That is at the other end of the spectrum. Things are still really glacial there, huge gap between buyers and sellers, but we are seeing more insolvencies there, more administrations, and that will inevitably force transactions.
Does that mean that we will actually see more deals activity? Are we picking up off a base there?
Yeah, off a base is the right phrase.
Exactly. It's a base. If you keep looking down, you might find it.
Yeah, I mean, we're talking about, in almost every market, at least the lowest transaction volumes since the global financial crisis. I mean, I think actually London recorded one quarter that was the lowest since about 2000. So, it did get really quite extreme in the sort of aftermath of Russia-Ukraine and, as I say, that bid-ask spread opening. But yes, it is coming back. We've seen volumes increase sort of quarter on quarter over the last few quarters. And again, it's you always have to take a pinch of salt with the brokers who, whose bread and butter is transactions. They need those deals to make their fees. But if you talk to them, they are the closest to the market, they will tell you that, yes, it's going to be a quiet first half, but they can see the conditions there and they're reporting on potential sales. They're trying to persuade investors to come to market for the second half of the year, and they see a bounce back there.
Okay, so you're expecting a strong sales pitch at this event
as
well.
ever, yeah.
What about the question of demand? Post-pandemic, we're shifting into sort of what looks like a more stable dynamic in terms of flexible working. When we think about demand for offices, how much is that playing into the picture given the kind of weak financial backdrop?
It's a huge question for real estate, offices being the biggest sort of asset class within commercial real estate. If you look at what happened to retail, which, probably 20 years ago used to be the sort of glamour sector within commercial real estate, these huge shopping centres worth, potentially multi-billions, totally upended by e-commerce, huge amount of value destruction. That's actually now finally found a floor, and, those things are trading very cheaply, but at least the rents have kind of hit a bottom and they're starting to grow again. All sorts of concern about, are we on the same journey now with office, having been sort of disrupted by, initially by WeWork even before the pandemic, this, shifts in the way that we work and what people expect from an office, and then accelerated by the pandemic. I think, as ever with these things, there's a lot of nuance required. There's a sense that, the good quality stuff in the best locations, the greenest stuff, there's still going to be a lot of demand for that. And actually there's more demand than there is availability because there hasn't been enough of it built. And I think that'll be another big theme at MIPIM, like the lack of construction that's been going on. But yeah, the older stuff, your regional office buildings, your suburban office buildings, especially those that, maybe aren't the greenest, they probably don't have a viable future as an office. And then you're starting to think about, well, do the economics actually work to turn them into something else? Do these things just need to get bulldozed?
Yeah, a couple of interesting points there. I mean, that idea of making buildings greener, essentially, more energy efficient, is another big challenge facing the sector too, because there are building regulations that are affecting how the future life and also how the new projects are going to be shaped.
Yeah, absolutely. And that'll be a big theme at MIPIM. It's an interesting event because it always attracts a lot of politicians, a lot of policymakers, and to some degree, they are not necessarily the main event. The reason everybody goes, the reason the thing works is because it attracts the investors. So you've got all the biggest sovereigns will be there, all the biggest private equity firms. And if they're there, then their brokers are there, their bankers are there, and then the developers are there. And there's this ecosystem, this sort of food chain. Yeah. and the politicians as well, they're there because they want to attract these people to come and invest in their cities. This time, there may be, to a greater extent, some of the investors listening quite carefully to what the policymakers have got to say around some of these sustainability issues, because it is going to be potentially a huge influence on things like that office market. How stringent are these rules going to be in the UK? There's talk of offices not being allowed to be rented out unless they're what's called EPC A or B by 2030. You're talking about the majority of the office market being illegal to rent in 6 years' time if that were to actually come in. So they will have a huge impact on the market. So I think it'll be maybe a bit more of a two-way dialogue than it sometimes is.
What about the question of housing? Of course, not as much of concern around house building as there is around commercial real estate, but still a sector that there's a lot of political and policy kind of perspectives to be had on.
Yeah, absolutely. And someone who's been going to MIPIM for 10, 15 years now, it's interesting how much more prominent housing is at the event. It's a huge part of it now. And I guess there's a couple of dynamics there. One, you've got the fact that really across Europe, there's almost no city that doesn't have a shortage of good quality housing. And they're all grappling with it in different ways. Some places it's planning, some places it's rent control that are barriers. And so that's lots of issues there to be grappled with by policymakers and by potential investors. The other thing is that, we talked about the kind of obsolescence in shopping centres and maybe what's happening now to offices. What you've seen investors do is that money that maybe they used to invest in retail or they used to invest in offices, now increasingly they want to invest it in living very broadly. So that can be rental apartments, it can be senior housing, nursing homes, whatever you like, but living broadly. The difficulty that they have is actually deploying that capital because there isn't the existing stock to go and buy it, and building it is very difficult because the rules, wherever you look in Europe, are complicated and they make it hard. So again, that's a huge focus. All this money that wants to get into European housing of various forms, but so many barriers to it.
Thanks to Bloomberg's real estate reporter, Jack Sidders. I'm Stephen Carroll in London. You can catch us every weekday morning here for Bloomberg Daybreak Europe, beginning at 6 a.m. in London and 1 a.m. on Wall Street. Tom?
Thank you, Stephen. And coming up on Bloomberg Daybreak Weekend, a look ahead to earnings from a couple of key technology manufacturers in Asia. I'm Tom Busby, and this is Bloomberg. I'm Tom Busby in New York with your global look ahead at the top stories for investors in the coming week. This week, two big companies will be reporting earnings. We'll take a look at how the EV market is performing through the lens of previewing battery maker CATL's earnings. But first, we'll talk about one of the major Apple suppliers, Hon Hai, also known as Foxconn. For more, let's get to Bloomberg Daybreak Asia co-host Doug Krisner.
Tom, in the coming week, we'll get fourth quarter earnings from the world's largest contract electronics maker, Hon Hai Precision Industry. This company is known internationally as Foxconn. It's a major assembler of iPhones and other Apple devices. In fact, Foxconn gets more than half its revenue from Apple. To help us preview the Foxconn earnings, I'm joined from Taipei by Jane Lanhee Lee, Bloomberg Tech reporter. Jane, thanks for being with us. So we know already that fourth quarter revenue was down by nearly 5.5%. And I saw that figure, and I'm wondering how much of it reflects the challenges that Apple is facing.
Oh, it absolutely reflects Apple's challenges. Foxconn makes about 70% of the iPhones for Apple. A lot of that is manufactured in China, and if China sales aren't doing well for Apple, then that'll reflect immediately for Foxconn as well. And the problem we're going to see going forward is that Apple iPhone sales, we reported last week, dropped 24% in the first 6 weeks of this year. And that's according to Counterpoint Research. And that already puts Apple behind Vivo. That's the number one selling brand in the first 6 weeks of this year. Huawei, which is considered China's tech champion, and they came out with a new phone, the Mate 60 Pro, late last year, and that has been selling gangbusters because there's a wave of patriotic buying. And then Honor, which is Huawei's previous brand, which kind of split off. And then Apple now, which used to be the top-selling brand in China, is in fourth place. That will have an impact on Foxconn sales. And during the earnings call on the 14th, investors and analysts are going to be focusing on outlook figures and outlooks or a color coming from the company on how much of an impact that's going to have.
So we know that Apple is facing a lot of challenges, as you just said, in terms of the China market. And we know at the same time that the company is moving to try to set up manufacturing operations in India. Is this something that Foxconn is involved with, the Indian facilities?
Oh, absolutely. Foxconn has been announcing almost every week or every other week. I'm sitting here picking up announcements on the Taiwan Stock Exchange about hundreds of millions of dollars that Foxconn is moving to India to get those facilities going. Bloomberg reported late last year that Foxconn has won approval to invest up to $2.6 billion in India. That hasn't yet shown up in a reduction of investments in China. But, going forward, the percentage of Apple products that Foxconn manufactures outside of China will grow for sure.
Do you think Foxconn right now is beginning to sense the need for greater diversification? I know they're involved in the production of other electronic components and networking equipment as well. Are they moving more aggressively to try to diversify away from being so reliant on Apple?
Well, that $2.6 billion India investment is already a clear signal that it is diversifying. Foxconn is the top electronics company in Taiwan. There are other major Taiwanese contract manufacturers, and all of them are in fact diversifying away from China. The Taiwanese government is supporting that as well. So there are places like, in addition to India, Thailand and Vietnam, other Southeast Asian countries are seeing an influx of investments. And Bloomberg last year also sort of graphed out the move of suppliers, and there's a clear increase in Apple suppliers in Southeast Asia.
Wasn't Foxconn involved in developing electric vehicles? If that's the case, are we likely to get an update on that movement sometime during the course of this analyst call on the 14th?
It's possible. There's a lot of interest in Foxconn's electric vehicle business. In fact, some analysts say Foxconn is trying to reposition itself as an EV company going forward as it diversifies away from just being the iPhone maker. But, the iPhones still make up for a big chunk of its sales, and EV really, it's in its infancy, and there have been several missteps in the last year or two as it tried to get its EV business going. So that's still a big question mark, and we'll have to see this year if it gets any big business. I'm keeping an eye on the U.S. to see if there are any U.S. brands that might decide to manufacture EVs with Foxconn. Investors will definitely be looking out for that.
Jane, thank you so much for helping us preview their earnings from Foxconn. Jane Lanhee Lee is Bloomberg Tech reporter joining from Taipei. Now let's get to the other co-host of Daybreak Asia, Brian Curtis.
Doug, Contemporary Amperex Technology, or CATL, is set to deliver fourth quarter results in the coming week. Bloomberg Intelligence expects to see solid revenues and cost control at the battery maker, and it says that will offset lower battery prices and the slowing Chinese economy. Putting it all together, BI suggests that the company will deliver resilient results. Now, of course, when we look at CATL's business, a lot of other issues come to mind. The health of the EV industry in China, stiff competition among EV makers there, U.S.-China relations, EU-China relations, carbon reduction targets, as well as industrial overcapacity in China, and even mandates for the use of electric heavy-duty trucks. Well, to unpack all of this, we have Bloomberg's transport reporter Danny Lee with us here in our studios in Hong Kong. So, Danny, how is CATL managing through these many crosswinds that we have at the moment in China?
Well, what we're going to see in its upcoming fourth quarter full-year results is not just resilient set of results, but one that could also be a record on the net income line, particularly when it comes to the full year. It's very robust as they have performed and gained from the benefits of the past three quarters. But even on the fourth quarter, the final quarter of the year, it's looking very, very strong. And they've given a wide margin for potentially what could be a record quarter ultimately. And so despite the falling prices of lithium and nickel, for example, these raw material prices actually are a good thing for someone like CATL, as they can become even more price competitive on its batteries and also just to sell at much lower prices.
Yeah. And not only a leader in China, but maintaining a top position really in the global market in the month of January. Just looking over some research from SNE Research out of South Korea, CATL with roughly 40% share of the worldwide battery market in January. It supplies automakers like Tesla, BMW, Mercedes-Benz, and Volkswagen. The number two is BYD. It's a big competitor and obviously a big maker of EVs. But let's talk about CATL's position vis-a-vis competitors and whether or not we might see some sort of consolidation coming.
There is a question, and there always has been in the recent years, over consolidation, not just amongst battery makers, but even across the auto space, across the whole. Brands which have launched running out of money. But when it comes to the battery space, you see this concentration even amongst the top two, CATL and BYD. And therefore, it's very hard for other suppliers to really gain ground, gain market share. And so when you have someone as financially strong and as robust as CATL in particular, they can use their financial muscle to squeeze margins and squeeze suppliers on costs and also just to get that edge over other smaller suppliers who cannot be as financially flex as CATL.
Is it generally considered to be a really well-managed company?
It is indeed, and when you look at what it has been doing to lay the groundwork, it has made long-term bets, even during this period of instability and weakness in the EV market, where clearly not many people are confident about the near-term demand, but ultimately they've made bets, they've invested, and they've put themselves in a position where they've conquered China, just like BYD has in the battery space for cars. They are now pushing very much abroad, but clearly there are headwinds when it comes to its reputation and how it's perceived and how it wants to be a supplier across the world.
It does actually seem, Danny, that the glide path for CATL globally, while, as you said, fraught with some difficulties over geopolitics, is pretty good because the pricing is not quite so competitive elsewhere as it is in China, right?
Yeah, absolutely. I mean, with China and with someone like CATL, they really have a lot of advantages when it comes to being able to sell batteries at much lower prices, and thanks to the falling prices of raw materials, they can continue to lower its prices. And when you do have other battery players around the world who are still just starting up, or they've still got higher costs that they need to factor in, so there's not a lot of room to maneuver for competitors. And for someone like CATL, this is their moment to say going for the kill rather, but they really are able to show their dominance and show not just their dominance but how good their products are, because what we have seen over the past couple of years is them putting out even better performing products, which, whether they be faster charging or have longer range, these are things which gives them an edge on all fronts, frankly, compared to its peers.
So you talked about the input materials being down, and that leads to the ability to lower battery prices. What are some of the key factors behind this fall in battery price?
It is a good question, and I think it's just we've seen with the speculation and the rush for these raw materials over the years, it has really helped push up prices. And again, when you see the concern about the long-term supply, that's all being locked into over recent years, that has helped push up prices. And we've seen the general demand for electric vehicles come down, and so therefore, naturally, prices for the raw materials are also coming down, but we haven't really seen a floor yet in the price, pulling back from near record levels. But ultimately, what we are seeing is the supply chain for EVs being laid out nicely, and we are seeing more sales, still growth, but maybe not as good as it once was. But we are at least seeing a normalization, which is, I guess, good for everyone, from companies to consumers.
All right, Danny, thanks so much for joining us. Bloomberg's transport reporter Danny Lee with us here in our Hong Kong studios. I'm Brian Curtis, along with Doug Krisner. You can catch us every weekday here for Bloomberg Daybreak Asia, beginning at 8 a.m. in Hong Kong and 8 p.m. on Wall Street. Tom?
Thank you, Brian. That does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.